This is Money Made Simple, the financial podcast that keeps it simple and gets to the point.
Kia ora and welcome to Money Made Simple, brought to you by Simplicity. Hi Liv.
Hey Jenny.
Hi. So today we're going to be talking about a topic that can make even the most experienced investor feel a bit uneasy. Market volatility.
And a really topical topic at the moment, right?
It is, and we know that it's something that our listeners will be thinking about. So we're going to talk about what it is, why it happens, and what it really means for your KiwiSaver and investment funds.
Yeah, and in kind of simple words, what that little squiggly line on your performance graphs of your KiwiSaver investment funds, kind of why it goes up and down, and what to do when they wobble.
Yeah, and the short answer is, so this podcast is going to be 1 minute long. The short answer is don't panic.
But let's unpack that, right?
Yeah.
So when people talk about volatility, they're really talking about how much and how quickly investment prices move up and down. So those big swings on the graph, up or down, mean that the market's more volatile.
Yeah. And the good thing to think about is that it's completely normal. So markets are active all the time. There are millions of people, investment fund managers, big institutions that are buying and selling shares every single day. And they are reacting to news, new research and data, politics, and sometimes just the vibes.
The emotions.
Yeah. So prices are going to move as investors are assessing all of this information that's coming at them, and they're thinking about what companies are worth.
Yeah, so volatility isn't automatically bad, right? It's part of how markets work. So prices adjusting, as you said, to new information.
Yeah. And if markets didn't move around, then it would mean that nothing is changing, like no new information is coming, no trading is happening. It would mean investors just aren't really paying attention, and that probably isn't a good thing. So it is just a totally normal sign of a healthy, functioning market.
Okay, so let's look a little bit closer at actually what drives volatility. So why do those big dips and spikes or little dips and spikes happen? There are a few big reasons, right?
Yeah. And the first one is uncertainty. We always say that markets hate uncertainty. And if you think about the last 4 or 5 years, there has been a lot of uncertainty in the world. Things like global conflicts, big changes to interest rates around the world, also unexpected government policies. If you think about what's been happening in the States with the trade tariffs, all that kind of thing. If the future looks a bit unclear and we don't know quite where we're going, then the markets tend to move more sharply than usual.
Yeah. And then, of course, there's emotion, which some of this is reactions to those things, right? So even professional investors can get spooked or greedy. Both things happen. If enough people panic and sell when something happens, prices will fall fast because demand and supply kind of comes into it. This makes more people then panic and sell, right? So it's like a domino effect.
Absolutely. It's kind of weird to think about it because I definitely didn't think of the market as emotionally driven. That was a real surprise to me that it's actually people not necessarily being rational, but just reacting to the stuff around them. So emotion plays a really big part.
And it's classic herd behaviour. So when someone does something, someone else does something, someone else does something, and that causes...
You're like, why are they doing that? Maybe I should do that.
Yeah, exactly. But the opposite happens too, the other way around from panic selling, when optimism runs high. So we've seen that in the last probably 1-2 years.
Yeah.
Everyone piles in, the prices shoot up like we've been seeing, especially in the US market, and eventually things correct.
Yes. That's absolutely right. The third one is new information. So I mentioned that before. Markets are constantly reacting to fresh data, fresh information. It can be things like company earnings, inflation numbers, election results, even a tweet from someone influential. So every piece of new information that's coming in can change what investors think about different companies, what their investments are worth, causing some buying and or selling to happen, and prices adjust accordingly.
So buying and selling causes prices to adjust, right?
Yeah. Sometimes these things happen quite smoothly and we don't notice over the sort of a period of time, and other times they happen really sharply and really quickly, and that's when we really notice.
But it's not just about humans, right? Like, I think those 3 things are around what humans do.
Yes. There's also some non-human players involved, not like machines or robots or anything, but it's more about systems and algorithms that have been set up that are automated and happening in the background. So things like index rebalancing might mean that certain companies fall off an index or other companies join, and so things are going to change there. There's something called, I have to look at this, arbitrage between markets.
Let's explain.
And that is where there are shares for the same company on different markets. So maybe you've got something that's listed on the NZX and also the Australian ASX. I find that quite hard to say. And maybe there's a slight price differential between them, like they're slightly cheaper on one of those stock exchanges. And so an institutional investor might buy them at the cheaper rate, and then they wait for that to rebalance, and then they sell. And we can be talking about tiny differences.
Like cents.
Yeah, but at scale, it can make quite a big difference. There's also algorithmic and technical trading that's happening, and that is where computer programs have been set up according to certain rules, and they're just happening no matter what is going on. They are not reacting to emotion or tweets or anything like that. Right. That's sort of happening in the background as well.
What about the viral meme stocks? Like GameStop?
That's a really interesting one though, isn't it? Yeah, and that is again about kind of people reacting to something that they see in the news media, and it might be completely sort of not based in reality even, and it can still...
But it pushes prices up and down,
It can affect prices, yeah.
Hedge funds... Like the US big hedge funds make big bets, right?
Yes, they do. And then when you're talking about big hedge funds, you're talking about millions, billions of dollars. So anything they do can make a sort of big impact. Yeah. So that's all happening. All of these forces are interacting with each other.
Yeah. And together they create those ups and downs that we see every day. There's so much that goes into it.
Yeah. And it can feel, we're this little country in the South Pacific, and most of these things are happening quite far away from us in other parts of the world. But anything that's happening in the US or China is going to ripple through and affect investors in New Zealand and Australia. And that's just because we live in a really connected world.
We're a tiny part of it, aren't we?
Yeah, and most of our KiwiSaver funds are going to hold international shares.
A large proportion of them, right?
Exactly. Yeah. So they're going to own shares in companies in the US, in Europe, in Asia. You're thinking about companies like Apple, Toyota, Nestle, that kind of thing. And we've got those alongside a small proportion of local investments. So it is going to impact us.
Yeah, so when those global shares and global markets move, your fund, based here in New Zealand, moves too.
Yeah.
The New Zealand share market is tiny. I think you had a stat, less than 0.5% of the world's total is the New Zealand market.
So
we're just
many.
little. Yeah. So what happens overseas really does matter and really does affect the values of our funds.
Yeah. So it might seem very far away, but a change in the US interest rate, a war in Europe, a supply chain issue in Asia, all of those things will affect our KiwiSaver and investments.
Yeah, but it's not always bad news, right?
It's
like
not. No.
Global growth, like what we've seen in the Magnificent Seven, those tech stocks that have been booming, that also affects our KiwiSaver investment balances.
We get the good and the bad, for sure.
Yeah.
The other thing just to mention is currencies. So we did a podcast a month or two ago about hedging, and we were talking about currency hedging, and because we are buying our investments in New Zealand dollars, but then the investments are being bought in USD or whatever, the currency exchange rate does actually have an impact on our investment balance. So depending on what's going on in the currency market, that can also affect
the volatility up and down.
And the volatility.
Yeah.
Exactly.
Okay, so let's look at a couple of examples of market volatility in recent years, which people might remember or have experienced.
Have you ever heard of the global financial crisis?
The GFC.
Yes. Of course you have. So that happened back in 2007. We argued about
2008.
this, 2007, 2008.
Yep.
And it was one of the biggest...
obvious ones.
Yes, market crashes. So it began in the US around a housing bubble, which collapsed. So it was after years of very excessive risk-taking by the lenders. So they were lending to people to buy houses in a very risky way. And then they were packaging those
Bad
loans, those bad mortgages, into very complex financial products and selling them on. To be honest, this just goes over my head. I don't really understand it.
Yeah.
But when those debts started to fail...
So those mortgages
started to fail, it exposed a real lack of, one, regulation, and two, just oversight. And it caused major issues in the States. Financial institutions came under a lot of pressure. Confidence completely disappeared in the system. And markets, not just in the US, but around the world...
Like we talked about,
sharply.
Things that happen overseas in one market have a domino effect across other markets. We're also connected and things are so reliant on other things. So markets fell by what, like more than 40%?
40%, which was, I think, one of the biggest in history.
That we will remember. in terms of,
In our lifetime,
Yeah,
yes, that's
exactly.
a good caveat.
And so at the time, it obviously just felt catastrophic, right? With homeowners defaulting on their loans, banks were then stuck with properties that were worth less than what they'd loaned out. Millions of job losses then came about in many markets, not just the US. Governments around the world started to scramble to step in. So it was a crisis.
It was a really, really big deal all around the world. But I think the important thing to know, if we're using this as an example, is that the people that stayed invested over this period of time recovered their losses within a few years. Those who panicked and pulled out their investments as the market had crashed, locked in those losses
40%,
and didn't benefit from the recovery. Yeah.
An example of crystallising your losses. Then there's obviously the COVID pandemic and the crash that caused in early 2020, March. So in just a few weeks, global markets dropped around 30%, so not quite as much as the GFC on average. It was the fastest fall in almost 90 years.
Yeah, and I think we were talking about this beforehand, that the 2007 GFC...
2008.
That was... We can agree to disagree. When that happened, KiwiSaver, for example, was absolutely brand new. A lot of people wouldn't have been affected by the market crash in 2007.
In terms of their
investments. It would have affected them more in terms of how it affected the economy more generally. But this was suddenly, people had been saving via KiwiSaver for 13 years, and to see their balances drop by up to 30% would have been a real shock.
Yes.
What people did was the same as the last example, was they panicked and they pulled their money either out of their investments or they moved it to a much more conservative fund, not knowing, and how could they have known, that the bounce would happen so quickly. So the markets recovered within 3 weeks of that crazy, lowest point. And so for a lot of people who hadn't reinvested it in that time, they missed out on all that growth. And again, crystallised their losses.
Yeah, and you were at Simplicity at the time, right?
I just started, yeah. And it was really scary. I remember talking to a guy who was trying to buy a first home, making a withdrawal to purchase his first home. And in the time it took him, about 2 weeks, to get all the paperwork that he needed ready to put the application in, 20% of his balance had disappeared. This really affected people.
But I think the important thing to remember is that it recovered. It has always done over history. Markets recovered.
Yeah.
And that's what people don't seem to be able to process a lot of the time when they are pulling their money out.
Yeah. So, yeah, like you said, it was one of the fastest recoveries ever. Part of that was because governments reacted really, really fast. They pumped money into the economy. People were able to work from home much more easily. So companies kind of found their way through that. And the markets bounced back really quickly within a couple of months.
Yeah, so those that left their funds invested basically benefited from the speed and strength of the recovery. So they recovered and then kept growing. While those that reacted by taking their money out or moving into more conservative investments may have locked in those losses.
Yep. So it just goes to show that volatility happens. It's a natural part of the system that we've created. Yeah. It doesn't mean that the system is broken. It actually just means that the system is reacting.
Yeah. So what does this mean, though, if you're a regular KiwiSaver member or an individual investor?
Mostly it means that you are going to see your balance fluctuate. So I think this is quite hard for people. If you're contributing regularly to KiwiSaver or to your investment funds, you...
hard-earned money,
yes,
right?
But you understandably expect your money just to tick up. That's not always the case. It can go up and down, sometimes a lot. And that can feel really uncomfortable, and it can feel a bit unfair too. Especially if you look one day and feeling really good about where you're heading, and then something happens and your balance is dropped. That can feel unfair.
Yeah. But the important thing to remember is that markets have always gone up in the past more than they've gone down over time. So that downswing will likely come back up as the markets carry on, recover, keep moving up.
Yeah, for sure. And especially when you're thinking about the average KiwiSaver member, they are investing for the long term. So even a longer recovery like we saw at the GFC,
which did
take a couple of years, for most of us, we're investing for years, even decades, and we can afford to ride those bumps, those ups and downs.
Yeah. And actually those bumps, those ups and downs, are kind of what makes long-term growth possible, right? Without some risk, there's generally a much lower return, correct?
Yes. That's absolutely right. There is something called the risk return principle. So if you look at, again, I'll just keep it to KiwiSaver because it's a bit easier. All the funds in KiwiSaver can be categorised into 5 fund types. If you start at one end, you've got the defensive funds, and they are pretty low risk, but they also have lower likely returns, more stable returns.
Less volatility.
Yes. As you work through and the risk indicator goes up as you go through the funds and you get to a high growth fund, which is going to be made up predominantly of shares, so it's going to be affected by the stock market the most, then you're looking at carrying quite a lot of risk and quite a lot of volatility, but over time you will be repaid for taking that risk through a likely higher return.
So higher risk equals higher volatility equals higher returns, likely.
Yeah.
And lower risk equals lower volatility equals likely lower returns.
You put that way better than I did. Yes.
Nutshell. So what should people do when markets get volatile?
Firstly, don't react emotionally. If you can,
hard.
check your emotions and don't go and check your KiwiSaver every day during a time of market volatility. It's not going to make things get better any faster, and it's more likely to feed that feeling of unease and panic.
Yeah, true. Second, I think make sure that you are in the right fund for your goals and your temperament. So if you're losing sleep when you see a drop, say you see your KiwiSaver balance go down by 10% and that freaks you out, you might be in the wrong fund type. So it might be too aggressive for you. On the other hand, if you're 25 and you're in a conservative or a balanced fund, you could actually be missing out on that long-term growth that higher risk and higher volatility gives. So really you need to weigh up your time horizon of your investing, so how much risk you can kind of afford to take, but also how much risk and volatility you can personally, mentally take.
Yeah, and be really honest about that, because it's easy to say, yeah, risk is cool when the markets
And I love
are
growth.
going well, and then when they crash, you realise that actually that feels really uncomfortable
It's what we
for you.
see a lot of, right? Yeah. Like we don't see a lot of chat when things are going up 20% year on year, which is unusual. And then we see all of the panic and reaction when things go down.
So there's some really good tools. We've got one, Sorted have got one, where people can go in and answer some questions about their investment time horizon and also their appetite for risk and tolerance of volatility. And then it's going to suggest one of those 5 fund types that I was talking about before that might be best suited to you as an individual investor. So totally recommend people do that.
Yeah.
The other thing is just keep contributing. And this is easy enough. With KiwiSaver, it's set up so that every pay cycle, some of your money's going into your KiwiSaver account. But if you think that when markets are down, you are actually buying more for your money. So you are getting more units in your fund for the same amount of money.
It's like it's on sale.
It's totally on sale. And then when the markets go up, then your investment balance goes up too. So it's there's kind of a silver lining to when the markets are down.
Yeah. And finally, remember, it's time in the market, not timing the market, that builds wealth. Even professionals cannot consistently predict when those swings up and swings down are going to happen. So staying in the market through all that is going to be your friend.
And keeping your eyes on the long term. That's basically it, right? Final thoughts. When markets fall, and the headlines can often sound really dramatic. I mean, we're hearing a few headlines at the moment. Starting to creep in. Don't panic. Those companies in the share market are still producing things. There's buying and selling going on. I think we get a bit blinded by headlines and the drama of it.
Yeah. The world doesn't stop just because the markets have crashed, right?
Yeah. And volatility is the price that we pay for growth. And it is a price worth paying when you've got time on your side.
Yeah. So the next time that markets get wobbly, whether that's tomorrow or in a year, no one can know. Just take a breath.
Remember, it's normal.
Yes. It's literally part of how investing works, right?
Yeah. So stay cool, stay invested, and focus on the long game.
And that's it. If you found this helpful, please bookmark this episode, rate, subscribe, share the podcast. Helps us educate more people. So cheers.
Thanks, everyone. Ka kite.
This podcast contains personal opinions and is intended to provide educational information only. It doesn't relate to your particular financial situation or goals and is not financial advice or recommendations. Simplicity New Zealand Limited is the issuer of the Simplicity KiwiSaver scheme and investment funds. For product disclosure statements, please visit Simplicity's website simplicity.kiwi.